I have to get one of those, or at least a quiet please. I hope I hope the landscapers and the leaf blowers don't start making noise in the background.
Well, I ended up going with the on-air sign because they didn't have one of those applause signs.
I see.
But
no, that's cute. Does that light up?
It does. It's really bright in the room, so you can't see it. But at night, it does light up.
They say light in the background gives the room dimension, and that makes it more interesting to look at. I don't know.
See,
well, you got some nice windows in the background, Austin. I like that.
Yeah, very sunny today.
And I have, I was going to say, I have my special guest up top here. I have our elf sitting on the shelf up there.
Okay.
So
I forget, what's your elf's name, Tom?
Our elf's name is Zippy.
That's
Zippy.
I love it. So Zippy's back.
Zippy is back.
Going.
Yeah.
Yep.
Joys of being a parent. All right, you guys ready to get started?
Yeah.
Sounds good.
Cool. Nick, you can cue the music. All right, cool. Hello, everyone. As always, my name is Austin Hagaman, and I'm here with Kate Fishbein and Tom Farrell from our sister podcast, Amplified Wealth According to Plan. The Financial Planning Committee just put out a great newsletter focused on the most impactful updates for individuals and families from the One Big Beautiful Bill Act. And there's some great content here as we end 2025 and begin the 2026 tax year. Welcome, guys. How you doing?
Greetings, Austin. Thank you for having us.
Of course.
Doing great.
I love the newsletter. I feel that when financial planning starts overlapping with these niche type tax strategies, it feels like I've been dropped into a wildly complex board game for the first time, and everyone else knows the rules and the rules contradict each other. And I just don't know what to do. I'm just trying not to lose on the first move. But you guys do a great job breaking it down, adding examples. So kudos to you.
It has been a bit of a tornado with all these changes, but that's, a lot of what makes our job exciting. And that's why we wanted to come and help our listeners today. And part of, why this newsletter went out, just to help break down some of these, complicated changes and things that happened with this, OB3 bill.
Yeah. Awesome. So where do you guys want to start?
So let's kick it off with Trump accounts, if that's okay. There's been a lot in the news about Trump accounts. And actually, there was a really exciting announcement yesterday from Michael and Susan Dell that they're actually giving $6.25 billion to children in these Trump accounts that are not part of that initial pilot program, which we'll talk a little bit about, and are under 10 years old in certain zip codes. So a lot of exciting, kind of news about these Trump accounts. So why don't we start with the basics, right? And I start to dork out whenever there's a new type of account. I don't know how you guys feel, but, part of me is like, all right, well, what are the rules? And why would somebody want to own or, open a Trump account? Why would someone want this type of account? So hopefully, we'll break down some of the specifics today, and we're hoping that you're going to, follow up, read the newsletter as well. But some of the basics, you have to be under 18 years old. So 0 through 17 years old. Once you turn 18, you're not eligible to make a contribution anymore to a Trump account. You do need to have a social security number, and you do need to be a U.S. citizen. Now, you cannot open, it's 2025 as of this recording, and you actually cannot open one of these Trump accounts today. You're going to be able to open these Trump accounts. The custodians have to get all this in place, right? There's a lot of work to do as a custodian to be able to open up these accounts for individuals. So starting in 2026, and likely these will be able to be funded after July 4th of 2026. So kind of, to be continued with opening these accounts. And then one interesting point about these accounts, right? You can only fund from 0 to 17. At 18, this account actually needs to be converted to an IRA, and it converts to a traditional IRA, and therefore all the rules of a traditional IRA then take over, right? So that's those, IRA contribution rules, any early withdrawal penalties, which we'll talk a little bit more about as well, apply. So
those are kids' accounts.
So they're for kids, yeah. And we'll talk more about it, but I think what's really interesting about this type of account is I think the intention was really long-term growth and allowing kids to get a head start And, dare I stretch into the realm of helping children prepare for, financial literacy. I want to believe that that was, the intention behind some of this. And I think that that might be some of the benefits of opening one of these accounts for your children.
Right. Well, what a great way to get someone hooked on capitalism, right? Give them a little taste.
Yeah. Right. But, and also help, children prepare for,
Sure.
The future. So I think part of the press that has, really gotten a lot of attention on these accounts has been this pilot program, right? And this pilot program was the announcement of the bill with this $1,000 federal grant for babies born between January 1st, 2025 and the end of 2028. So how cool, $1,000 if you have a baby between this time period. And all the details of, how this account is going to be opened / funded, it's kind of pending. So I would say if you've had a baby this year and or are expecting in the future or plan to have a baby within this time frame, make sure you're keeping an eye as to whether or not you have to open this account or if the Treasury will automatically open this account so that you don't leave this free money on the table. How cool is this? Right? So it's kind of getting, a head start for some of these babies. And again, that's just that pilot program. And if you're under 17, you can still fund and open an account, a Trump account, but you're not going to get that $1,000 seed money unless you're born within that certain time frame. Again, remember I just mentioned that Michael Dell and Susan Dell contribution. Mm-hmm. That's actually going to apply only if you don't apply are counted in that kind of pilot program time frame, and for kids under 10. So again, keep an eye out on some of that free money that's out there and making sure that if you do qualify, open that account so you can get those funds.
So if you had a baby in 2024, Kate, as opposed to starting this year, then the Dell family contribution could apply.
Just announced yesterday. So kind of, keep an eye. I don't have all the information, but, spoiler alert, make sure you're keeping abreast of, any potential funds out there.
Right. And what a great commitment by the Dell family, by Mike and Susan, right? It almost makes you wonder if Mike or Susan is looking at a political career sometime in the future.
Yeah, I'm not sure. I'm not going there, Austin. Not going there. But what
start planting the seeds now. I see how that could unfold in the future.
Well, and what's cool too, right? So you're capped at this $5,000 annual max contribution, but any of these charitable contributions actually don't apply, from my understanding, to that $5,000 max. So you can still kind of get that money from the Dells and then still continue to contribute up to that maximum annual amount. So.
And Kate, I got a question about that. So the maximum is the $5,000 mark. And forgive me if you said this already, but if you qualify for having a baby 2025 through the end of 2028, and you get that automatic or the federal grant, the $1,000, does that count towards the $5,000?
It does not. Is my understanding that is in addition. Okay. So you could also do that $5,000 on top.
I think the article points out some of the impact if you have friends or family that are interested in helping out in terms of funding these accounts. Those contributions would count towards that annual max.
Exactly. Yes, and that's actually part of the cool thing about this account is it's that $5,000 annual max, but anyone can contribute to it. So that could be grandparents, that could be friends, that could be relatives, that could be your neighbor. But you're maxed at that $5,000. And also of interest, there's that $2,500 annual maximum employer contribution as well. Now that does count towards that $5,000 annual max. So just keeping an eye on that. Now, when you as a parent are contributing to this account, or if relatives are contributing to this account, that essentially forms basis in the account. You're not getting a tax deduction for making a contribution to the Trump account. So I'll talk more on that taxation of withdrawals in a second. But keep in mind that, any of your contributions or your relatives or your grandparents are going to form basis in the account, whereas that federal seed money or employer contributions are not going, those are going to be not taxed to you in the year that you receive them, but there will be different tax implications when you actually take that distribution out of the Trump accounts. So a lot going on here. And again, the custodians have a full plate in terms of preparing for, getting ready for this type of account.
Yeah. So Kate, so when you or friends or family contribute to the account, does that count towards your gift tax exclusion?
That's an excellent question, Austin. That's something I got to look into. I don't know if it counts towards the gift tax exclusion. That's something to, again, there's some parts of this that I think are still unfolding and we don't have all the answers just yet. But that's something to look into.
I'll venture out and comment on that. And again, we can confirm how the rules work here. But if you're making a contribution on behalf of somebody else, it's considered a completed gift, I would think that it would count towards the annual exclusion amount, which right now as of 2025 is $19,000 per person. But you bring up a good point, Austin, in terms of, how folks are thinking about gifting to family members and all the different ways that you can do that, right? 529s are an example. UTMA accounts are an example. These new Trump accounts are something for investors to think about. And then factoring that into how that plays a role in terms of the annual exclusion gifting would be an important thing to sort out and think through.
Definitely. And what I think is also really neat about these Trump accounts is, when you have a child and you're trying to do some long-term saving for them, if you were looking at an IRA account or even a Roth IRA account, remember, you're going to be impacted by those income requirements, right? So essentially, to be able to contribute to either a Roth IRA or a traditional IRA, you need to have that earned income requirement. Thus, is not the case with the Trump account. So, your child doesn't need to have a summer job for you to be able to put these funds into this Trump account.
Yeah.
And also, there's no income cap. So if you have mom and dad, or they're a high earner, you can still contribute funds to this Trump account. So exciting.
Yeah. So there's some good trade-offs here, right? The fact that you don't need earned income for the beneficiary, but at the same time, it's only capped at $5,000, right? Which is less than where the IRA contribution limits are by a couple $1,000s so far. I think what'll be interesting is how the timeline of this plays out, Kate and Austin. Yeah. How soon will financial institutions be ready to start accepting these and have the mechanisms in place to to track it and have all the reporting that's necessary on an annual basis and stuff like that. And then I guess at the same time, the government being ready to make those contributions for eligible babies, right, that are being born every single day in the United States. So. Right. We have 2 kids, and I don't know. Maybe I need to think about expanding the family.
Well, and one more point to throw at you too. Yeah, in terms of the benefits of this account. So remember, you're not getting that tax deduction for putting funds into the Trump account, but you are getting tax deferred growth while those funds are in the account. So I think that's exciting. And also that $5,000 max annual contribution amount, that will start to adjust for inflation in 2028. So our slide on, that we're sharing right now shows this kind of flat $5,000. That's not entirely accurate. That's really just for, illustrative purposes. But come 2028, that 5,000 cap will start to adjust for inflation. So right. You gotta adjust for this pernicious, impact of inflation over time. So it's a good thing.
You could save a good deal of money in these. I mean, you grow 5,000 entering the account a year by 10%. That's over $100,000. By the time the kid's 18.
Austin, you're reading my mind. Did you? We're gonna get to that next.
Did you read the newsletter, Austin?
Am I moving ahead?
So let's talk about the withdrawals. We talked about, how to get money into this thing. Let's talk about withdrawals. So I think, right. So you're like, oh, this is great. This sounds great. Why wouldn't everyone do this? Right. So, well, maybe because there aren't withdrawals allowed before 18. So if you need at these funds before 18, look elsewhere. So once you make those contributions, that's it at 18. Remember, at 18, it converts to a traditional IRA. And I don't know, by a show of hands, how many responsible 18-year-olds do you know, remember at 18, this becomes assets of the child. And I know, as parents, even though we might try to, emphasize the importance of letting funds grow and compound and, more on that, still 18-year-olds will be 18-year-olds. And hey, are we going to use this Trump account, take a distribution and, buy a car or go to Cancun or, whatever might happen. So something to think about. And then at 18, all those IRA rules apply, right? So those 72T rules apply. So you're going to get hit with that early withdrawal penalty before 59 and a half, right? Unless it's used for educational purposes or you get that $10,000 first-time home buyer, exception as well. But, unless it's for one of those qualified exceptions, you're going to get hit with, that 10% early withdrawal penalty. And remember, I mentioned earlier that you've got this combination of kind of after-tax and pre-tax funds in the account, right? So those after-tax amounts are essentially any of those contributions which have formed basis in the account. And then you've got those pre-tax funds, which, are the earnings that have accumulated over time, as well as any employer contributions or any of that kind of pilot program or contributions that you received from the government. All of that money comes out taxed as ordinary income. So you're going to get this pro rata rule that does apply. So you're going to have a combination of, contributions coming out that are not taxed, but you're going to have that any of those pre-tax funds that would be taxed as ordinary income. And of course, I'm not a CPA, so make sure, when that time comes, making sure you're reviewing with your CPA any possible tax, implications.
Very interesting. Yeah, it'll be interesting to see how people use these, because I'm just thinking about it live right now. And if it becomes an IRA, so then when you eventually pull the money out, it's taxed as ordinary income. As a parent, with the basis, as a parent, and if the gift tax exclusion applies, right? As a parent, am I better off giving $5,000 into a Trump account or $5,000 into a trust or an UTMA account where it's going to grow, and perhaps, my child is going to pay long-term capital gains rates, right, when they pull out the money, as opposed to ordinary income on all that growth?
Yeah, it's a great question.
Good point. Yeah.
Remember, you are getting that tax deferred growth. So I think you got to kind of think about, ultimately when are the funds going to be needed? What are they going to be used for? And then also, are there some planning opportunities here too? If you have a responsible 18-year-old, at 18, you have money that's held in a traditional IRA. Are you able to convert that into a Roth IRA when their income levels are low and allow that to continue to grow? But knowing that obviously anything you're converting is going to be, taxed as ordinary income. So making sure that you're watching those, brackets and making sure you're not setting yourself up for a tax nightmare.
Right.
Yeah, it's a new opportunity, right? This is something that I think more and more families are going to start to think about as more information comes out about how they work and how families can use them. And Austin, to your point, I think it's going to be, another opportunity to discuss in terms of what is most important to each family, right? And it could be just another bucket, right? They could be allocating funds to potentially a trust or a 529 or a UTMA. And then at the same time thinking about, okay, how can we utilize Trump accounts to our family's benefit over time? So, I think this will be, I'm anxious to, get more of the institutions ready to go on this, right? And to see some of the, the rubber meet the road here, for lack of a better phrase. But it's a new opportunity, and we'll get some more information about it and talk to clients about it. Yeah.
And there's free money on the table, right? There's the $1,000 from the government. There's the money from the Dells if you fall within that application, and then potentially from your employer, right? So this is a good addition, I think, a good bucket in terms of collecting that free money that's out there that you can get from these different sources.
Right.
And to your point, Austin, our next graphic here is going to illustrate the beauties of compounding. So we've always talked about compounding, and Einstein, remember, has called compounding the eighth wonder of the world. But it's another thing to see it graphically illustrated. So before we kind of show this quick illustration, just to discuss how Trump accounts need to be invested. So they can be invested, but they are going to be limited to certain investments. We don't have all the details yet, but from what we're hearing, they have to be low cost. From what we're hearing, a domestic kind of index fund via either an ETF or a mutual fund, but there are going to be some restrictions in terms of what you can invest in these Trump accounts. So for our hypothetical investment, let's assume that there's a $5,000 annual contribution. To simplify things, we're not going to adjust for inflation. Let's assume a 6% growth rate. And what are these values, at the end of the year? So we see that, with this annual $5,000 contribution at 18 years old, there would be $173,000, Austin, to your point, in this Trump account, right? So that's plenty for, a trip to Cancun or
For sure. Yeah.
That's a lot of money for an 18-year-old.
It's a lot of money for an 18-year-old again. But I think, what the excitement about these accounts are too, remember, is creating this financial literacy, right? Giving kids the knowledge that, they've got a bright future ahead of them, and, it's worth saving for. So some of those exciting, getting the kids invested and feeling like they're part of this game could be one of these benefits, but also making sure that you're having the conversation as to, hey, what are these funds for? What are the appropriate uses of these funds? What are the inappropriate uses of these funds? So just let's play this example a little further out. So again, just not contributing anything else. Having that $173,000 Trump account. Remember, you're converting to an IRA at 18 years old. At 60 years old, without any other contributions, obviously, and no distributions too, this account would be worth over $2 million in market value, assuming that 6% growth rate. That's phenomenal. So I think this is the beauty of this type of account, because we know the one thing that's really exciting about compounding is time. And this Trump account is allowing for the extension of that time by getting those funds in even earlier, right? You're not able to do an IRA account unless your child has earned income. So this is allowing you to kind of start that process going and getting funds into the children's name, and allowing this beautiful thing of, called compounding take hold.
That's fantastic. And, and it's also, it lets the parent kind of give a little pat on the back to themselves for being so diligent by adding $5,000 a year to their kids' account. So
right.
It's a
$5,000.
Not bad, right? It's a family effort.
For $5,000 a year, your kid won't have to ever work, right? They got the retirement taken care of.
But then maybe keeping this chart on hand, so, at 20 years old, when something seems more important than your 60-year-old self, saying, hey, this is why we're doing this. We're doing this for that growth, and sticking with it is really the key, because it's not about trying to time the market, it's time in the market, and keeping these funds working for you over time is how you're going to win that game.
I could see this on the wall in the kid's bedroom next to the Knicks poster. Right.
Right. So, it's a good reminder.
That's a great illustration. And we just want to say a big thank you to our colleague, Andrew Gabriel, one of our fellow wealth advisors and financial planners on the team, who authored the article on Trump accounts in our newsletter.
Yeah, thank you.
Great job, Andrew. Super. So now that we've started, why don't we, with babies, why don't we flip to seniors and talk about the senior deduction? So I think there was a lot of misinformation, from the early get-go, or not misinformation, maybe, I guess it was part of the campaign efforts. There's a lot of talk about, there won't be any taxation on Social Security. Well, I think maybe this was the compromise in OB3, where there's this extra senior deduction. So, it's not that Social Security isn't being taxed. There's this new senior deduction, which is really exciting. But, here's kind of the water in the face. It does start this year in 2025, but it only goes through the year 2028. And there are income thresholds, which we're going to talk about too. But let's break this example down. So this extra senior deduction applies whether you're taking the standard deduction or if you're itemizing. So that's awesome. This example that we're going to go through is going to illustrate someone who would be taking the standard deduction. And these figures are going to be the 2025 figures. But let's see how this new standard deduction might integrate with existing deductions for someone taking the standard deduction. So let's say you're single and you're 65 or older. Look at you with that pointer.
Look at me. My first rodeo here.
You're driving from now on. That's it. So for someone single and 65 or older in 2025 who's taking the standard deduction, you've got the $15,750 standard deduction. So you're taking that, and that was also updated in OB3. Then remember, you get that already, that 65 plus or blind, there's that extra $2,000 for someone single. So you're going to take that extra $2,000 plus, assuming you're within the income range, you're going to get this new $6,000 bonus senior depreciation as well. So that totals a whopping $23,750 for someone who's filing single and over 65. That's a big deal.
That's meaningful. That's a car.
That's a car. Yeah, that's a lot. So let's play it out for someone who's married filing jointly on their tax return, but where only one spouse is 65 or older. So remember, you're married filing jointly, standard deduction is going to be a little bigger because there's two of you. Okay, so that's fair. So $31,500 is your standard deduction. Plus, you're going to get that little extra 65 plus or blind deduction as well. But since there's only one of you that's 65 or older, you're going to get that $1,600 deduction. And then you're going to get, as long as you're within these income thresholds, that extra $6,000 bonus senior depreciation for a whopping $39,100.
That's an even nicer car.
And let's go one further. Let's look on the newer part of the lot on. And all right. Now married filing jointly with both spouses over 65. You've got that $31,500 standard deduction for married filing jointly. Then because there's two of you 65 or older, instead of that 1.6 extra deduction, you're now going to get 3.2. And now you're going to get that 6,000 also doubles. You're going to get 12,000 based on this bonus senior deduction for a whopping total of $46,700, assuming you're within the income thresholds. So these are huge numbers. So really can have a big impact. And let's talk about those income thresholds, because again, when you're maybe when you're doing some Roth conversions or when you're taking required minimum distributions and you're like, should I do that QCD? You really want to watch your income levels, because on our next slide, you want to be making sure that maybe you don't, edge yourself out of maximizing this benefit. Because remember, again, this benefit's only going from 2025 through 2028. So this is kind of get it while you can. So these income phase outs. So there's a MAGI phase out limit for single individuals, for single filers of 75,000. So under 75,000, no problem. You get that 6,000 bonus depreciation. But between 75,000 and 175,000, if you're filing single, you're going to have this phase out. And what that phase out looks like, and we have these two graphs here, and on the left axis, that's going to be the amount of the senior deduction. And on the lower axis, that's going to be the income level. And you'll see it goes from 6,000 all the way to zero. So essentially you're fully phased out of this single bonus senior depreciation at $175,000 for modified adjusted gross income.
And that for people who may not be as tax savvy, that's basically the number where the IRS is saying, okay, show me what you made really, right? It's a number, it's a cleaner number than a number that takes into account certain deductions, things like that. So it's just a cleaner way of showing, the IRS what you actually made.
Yes. And keep in mind too, that MAGI can be different for different tax purposes. It's my understanding that this MAGI does not add back municipal bond income. There are a couple of other factors, but you're absolutely right, Austin. And again, that definition can mean different things for different tax purposes, because why would it be simple? So the deduction is 6 cents, or to really simplify it, I like to think of it as 6% for every dollar of MAGI above that threshold for someone filing single. Or it's 12 cents or 12% for someone who's married filing jointly. So let's give an example. Well, actually, I failed to mention the married filing jointly income phase out limit, and that's $150,000 to $250,000. So again, if you're married filing jointly and you're under $150,000, $12,000 extra senior bonus depreciation deduction. And anything at $250,000, no bonus deduction for you. So let's give an example of a married filing jointly where both individuals are over 65. And let's say that this married filing jointly couple is earning $175,000 of modified adjusted gross income. Let's go through how to calculate that phase out and what their deduction would be. So essentially they're $25,000 over that threshold, that income threshold, that $150,000 to $250,000. So at $175,000, they're $25,000 over the limit. So you take that $25,000, you multiply it by 12%. Essentially, you get a $3,000 reduction in the bonus senior deduction. So you take what it would have been, that $12,000 bonus deduction, less that $3,000 reduction, for a $9,000 bonus deduction would be applied.
I guess it's important to point out that, what we're talking about here in terms of phasing out is just this new additive deduction benefit. So I guess, one analogy could be you still get your standard deduction plus the age 65 normal extra deduction that you talked about before, Kate, which for a single person is $2,000. For married filing jointly, it's $1,600 per person. Those are still there. Those don't phase out. This new bonus amount does. So they're essentially taking away, if you're making too much money, they're taking away the icing on the cake, but you still get your cake.
It's a great point. Great way to put it too.
Yeah, exactly. Makes a lot of sense.
Yep, for sure. So
I think what's important with these phase out limits is there's something to be aware of, but not something to be deathly afraid of, right? I think when everything's said and done, you have to focus on the long term. What's the net tax effect over a 30-year period or a 15-year period, as opposed to, what could you save today by avoiding this phase out, right? You always want to take in everything together and not let the tax tail whale the dog, so to speak.
It's an excellent point. Still having that long-term focus. And again, this is a short-term kind of little bonus deduction. So, you want to take advantage of this if you can, but yeah, keeping your eye on the ball and the long-term gain is probably more important.
Yeah, I think it highlights the fact that the tax bill that we're referring to as OB3 has so many provisions in it, and some of them have different starting dates, right? So, Kate, as you pointed out here on your slides, is this is a very temporary addition for deductions for folks that are age 65 and older, and it just should be added to the playbook on how you think about your income and deductions and what decisions you might make in your own personal situation, given the fact that this is here and available starting in 2025, but it goes away after 2028.
Yeah. And is this a reason to delay certain income? To make sure you can take advantage of this. Again, looking at the whole picture and putting all those pieces together and the risk reward, profile.
Yeah.
And then just some kind of like closing thoughts on this. Again, this is in addition to the current senior deduction and the standard deduction. Or if you're itemizing, this does not eliminate, the taxation of Social Security benefits as mentioned. So you don't need to be taking Social Security to be able to benefit from this potentially. So that's a great thing. This is not an above the line item for tax purposes. So this isn't going to reduce your AGI. That'd be great. And this is not a refundable credit, but, it can reduce your tax bill. And it could potentially reduce your tax bill to zero if that's your situation. And again, this is a short-term, little senior bonus deduction. So kind of get it while you can. Of note, though, if you're married filing separately, you're actually not eligible to take advantage of this. So, and something just to review with your CPA. And again, look at your particular tax situation, your tax landscape, and make strategic decisions based on these changing rules.
Yeah, this is great content. Great to keep in mind whether you fall in that age bracket or whether you have parents that fall in that age bracket, right?
Definitely.
And once again, I'll say thank you to our colleague, Kenny Ferrari, who authored this article in our newsletter. Please check it out when you have a chance.
All right. So what's the next big topic here?
All right. So our next topic that we highlight in the newsletter is some of the changes that the new tax bill applies to. While we're on the subject of deductions, let's keep it going with how charitable deductions work. And, again, just to, be clear on when some of these rules start. So the changes that will be made to the deductibility of charitable contributions that we'll talk about here start in 2026. So that's important to remember. As we record this, we're in December. I know time is of the essence, but for taxpayers out there that are already charitably inclined, you may want to think about potentially making some adjustments to your donations in the calendar year of 2025 before some of these new changes take place. So let's talk about what some of these new rules are. And, I guess I'll describe it as come next year, there's going to be some new guardrails that are placed around charitable deductions. So let's talk about the first one. They're going to institute what we're referring to as a floor or a hurdle rate on charitable deductions that are eligible to be deducted on your tax return. And that floor is equal to 0.5% of your adjusted gross income. And, we're familiar with this kind of a concept. If you think about how medical expenses flow through on your Schedule A for deductions, that's had a floor. It's changed a couple times over the last several years, but generally speaking, it's about 7.5% of AGI. Medical expenses that are above that amount are deductible on your tax return. And so, the new rules here under OB3 say that, that 0.5% of AGI, and that would translate. So let me just give you a couple different examples here. So for a taxpayer with adjusted gross income of $500,000, that means that the first $2,500 of charitable contributions would not be eligible for deduction. Okay, that's this floor, right? For somebody earning $750,000, that's their adjusted gross income for the year, then the floor would be $3,750. Okay. And for somebody earning $1 million, nice and clean, 0.5% of that is $5,000. So in other words, if you're donating $15,000 to charity and your AGI is $1 million, that first $5,000 is not eligible for deduction. And so even though you gave away $15,000, only $10,000 of that would be eligible for deduction. Again, this starts next year. So it'll be important for taxpayers to one, pay attention to the level of contribution that they're making, and two, obviously, have a good idea of what their adjusted gross income is going to be for the year, so they have a good understanding about where that that hurdle rate and that floor would begin. Because it's, Austin, you mentioned before, some of these new rules, we just need to start to think about how this would impact, right, the year-to-year decision-making, right? So it's something to be aware of. You're still going to be able to make these deductions if you make contributions to charity. There's just some new nuances to think about starting next year. The good news is right now, 2025, there is no hurdle rate. There's no floor. So the first dollars are eligible for deduction given your particular tax situation.
All these rules. They love their rules.
They love the rules. And all these
rules.
timelines too are it's a lot. So Tom, this is for someone who's itemizing, right?
Yeah. So that's an important distinction to make. You just highlighted the expansion of the standard deduction, right? We saw that through the Tax Cuts and Jobs Act. That's essentially been continued through OB3. So the larger standard deduction is, one of the quote unquote permanent features of the new tax bill. And then they have this temporary piece that you just highlighted, Kate, for folks that do not itemize. This is a provision for taxpayers who are itemizing, which means that you would choose that if the amount of your deductions, eligible deductions, everything from mortgage interest to state and local taxes to medical expenses if they're above the hurdle rate to charitable contributions, if that all is greater than what your standard deduction would be, right? You always need to compare the two. Which one gives me the bigger bang for my buck from a tax standpoint? So yeah, this is for itemizing.
Yeah, and so with that larger standard deduction, sometimes it's harder to get above that makes sense to itemize level. After you add up all those pieces.
Yeah.
And so what's interesting here too is that it's a percentage, right? So essentially, the more you make, the larger that hurdle will be. So again, to your earlier point, it's almost like, all right, just a bigger hurdle. If you're making more money, it's a bigger hurdle to get over, but it's still a hurdle and a change and starts next year.
So that's on the let's say that's on the bottom side, right? Bottoms up. From the top down perspective, starting in 2026, the tax law will cap your benefit. And so one of the important things to know about how the new rules work is, tax deductions are a function of, what marginal bracket are you in, right? And so the highest federal marginal bracket is 37%, right? That's one of the provisions that was extended through OB3 as well. And so, if you're a taxpayer in that highest marginal bracket, then the way to think about the value of my deduction, right, is looking at that highest marginal bracket and applying that to your deduction. What the new tax bill says is that, hey, listen, new rules are there's a 0.5% on adjusted gross income in terms of a floor on the bottom side, and we're not going to give you a tax benefit at the highest marginal bracket at 37%. We're going to cap you at 35%. All right, so that's the easy way to think about this. The way the tax bill is written, and again, back to our comments about how complicated some of this stuff can be, and I like to kind of use the phrase "clear as mud," right? The way they write it is, you're capped at a 2/37th benefit. Right.
Who says that? Who says 2/37?
Not me. Not me.
Yeah. 37th minute.
Yeah.
Right.
Which is just it does sound ridiculous, but if you're reading through the article or you're just brushing up on how this works and you're talking to your tax advisor, the rules essentially say that your deduction is reduced by the lesser of your total itemized deductions or the amount of your AGI plus your total itemized deduction above the 37% bracket. And so then you apply the 2/37ths, Austin, your 2/37ths math to that dollar amount, which essentially equates to 5.4%, right? So you would multiply what you gave. And in the article, we talked about total itemized deductions about $75,000, and if you multiply that by 5.4%, 75,000 is reduced to roughly 70,000, right? And then if you multiply that 70,000 by the 37% bracket, your benefit is essentially equal to 35% of that. So it's a long-winded way of saying the cap for the highest earners out there is no longer 37% starting next year. It will be 35%. So that's why I kind of use this guardrail term, right? So starting next year, you're going to have these guardrails on the top side and the bottom side. And, the graphic here may not be the best, but what I was trying to implicate is, compression on the top and some compression on the bottom, kind of like getting smashed in the middle there.
I think that's a great way to put it, Tom. And I think, having that image even in my head, I think is very helpful. And so it really sounds like, probably some of the higher earners are really going to be the ones that are impacted by some of these changes to charitable giving, by, kind of shaving off a little from the floor, and then also maybe getting capped on that upside as well.
Yeah. And, I think from a strategy standpoint, when folks are already charitably inclined, right? So again, this is for folks that are, this is part of their life. They want to give back and they're interested in supporting different organizations and things like that. And typically what we see is that families do this on an annual basis, right? They say, okay, this year we're going to give XYZ to this organization and that organization. And if you think about the general level of giving that a family would be considering in any given year, if you want to think about how to maximize the benefit here, and also, if you're thinking about timing when this new rule comes into play, which is next year, and there's still some room left in 25 to take action, you might think about, listen, if I was already going to give, $20,000 a year for the next 5 years or so, I'll just potentially think about accelerating maybe some of that gifting. Maybe I'll do more this year, right? Because I wanted to benefit those organizations anyway. And I have the financial wherewithal in order to give this money away in the first place. And maybe I get a bigger bang for my buck if I bunch those contributions up into one particular year by, let's say, donating something like a donor advised fund, where the tax deduction can be taken in the year in which the contribution was made to the donor advised fund. And now you have this new bucket, right? That's one example of, this whole charitable giving world where, you've created this investment account that's really there for long-term charitable giving. And then you're in charge of when you make those distributions out to the organizations that you want to benefit. So that, we talk about that in the article in terms of how to think about strategizing about your gift giving and, how you could be doing some of that giving and also thinking about the timing and when some of the new rules work.
Yeah, great.
I don't know,
especially this time of year.
I don't know about our listeners, but I haven't heard a word you said since you said 237th. I feel like, what was that written in the style of the Gettysburg Address?
I should have had that on my slide.
Four scores and
237th. Yeah, there we go.
The math in your head. The long division fraction.
No, but the donor advice fund is a great idea. It's a great application for this.
Yeah, and and we talk to our clients about that, and we have some content out there on donor advised funds, and if you also think about it from the perspective of how to leverage those gifts, if you already have low basis securities in an investment account, it's a great way. You don't have to give cash. You can give cash, and one of the good things is the new tax bill does make permanent the higher deductibility if you're giving cash to charity. It used to be 50%. Now it's up to 60%, 60%, if you give cash to eligible charities. So there's still a benefit there. But if if you're an investor and you already own low basis securities, if you wanted to sell those, you'd have to pay the capital gains. You could think about giving appreciated securities to the donor advised fund, for example, where the market value of that security is used for the contribution purpose. You're limited to 30% of adjusted gross income, but now you're no longer on the hook for paying the capital gains tax, should you sell any of those shares moving forward. So there's lots of different ways to think about, one, how am I giving? Two, what am I using to give? Is it cash? Is it securities? Is it property? Things like that. But lots of different ways to approach this.
Yeah, no. If you're giving money anyway, giving a concentrated stock or low cost basis positions with high unrealized gains seems like it makes a lot of sense. Why not?
It's a win-win, right? It's a win-win. It's a win for you. It's a win for the charity. It's great.
Right.
Absolutely. I think our next topic, I think that's the, Nick, let me just start over here. So just in terms of, comparing 2025 to 2026, we have a slide here for folks that are watching on YouTube, where we're pointing out that the new floor or hurdle rate of 0.5% starts in 2026. The new cap on charitable deductions in 2026 is 35%. None of that applies in 2025, of course. We're also talking about folks that are itemizing. And one other little added benefit that was created under OB3 that centers around the charitable giving world is for non-itemizers. Starting in 2026, there will be this extra benefit, if you will, where if you're giving to charity and you're married filing jointly, you can deduct up to $2,000 just automatically, right? So if you're already giving to charity and you're not giving to the level where you would be itemizing deductions, you could still at least deduct up to $2,000 married filing jointly and $1,000 if you're a single filer.
And one interesting point there, just to note too, that needs to be cash. You can't do appreciated securities for that, is my understanding. And also, you can't use that for donor advised funds. That needs to be a cash contribution in order to get that extra deduction in 2026 for non-itemizers.
So if you're operating that way and you're already doing that, this is essentially a nice benefit. It's a no-brainer. You just want to make sure that you're taking advantage of it when you're filing your taxes. All right, and I think our next and maybe final topic, if I'm correct, is it's the temporary increase. Again, temporary. This goes to all the provisions in OB3 and when they start and when they finish and things like that. Some of them are permanent, quote unquote, and some of them are only temporary. And this is one of them. So SALT is short for state and local tax deduction. Before the Tax Cuts and Jobs Act, folks who were itemizing and, let's say you lived in a high income tax state like New Jersey or New York, for example, those taxes you paid to the state, and then property taxes on, let's say the house that you lived in, those were eligible deductions. And, if you live in a state like, I live in New Jersey, it's the highest, we have the highest property taxes in the nation.
I feel your pain, Tom.
So, those dollars really added up to, sometimes quite large deductions if you were itemizing. And so that got taken away. Or not taken away. That was limited, very much so under Tax Cuts and Jobs Act to $10,000 per year. And on the flip side, the tax bill said, but hey, guess what? We're going to increase the standard deduction by a pretty good margin, right? So there was a benefit there. And depending on your particular situation, you would do the math and, that standard deduction could still be quite attractive, given your situation. What the OB3 bill does here, because there's been a lot of pushback, especially from some of these high income tax states, is to provide some benefit here. And so what they did was they came to terms on a temporary increase that's going to be in place for 2025 through 2029 only, right? This is, I kind of equate this back to what you were talking about before, Kate, on the senior deduction, right? This is additive, and then it goes away. But what's left in its place when it goes away is back to where we were before, right? Which is the $10,000 cap on state and local taxes. That's what's going to come back onto the books come 2030. And you can see that on the slide that we have on the screen here. So the new limit is 40,000 starting in 2025. The nice thing is that increases by 1% each calendar year through the end of 2029. So by the end of 29, that 40,000 grows to about 41,600 and change. And before it goes back to 10,000. And of course, if you earn too much, you will be phased out of this deduction. And so the phase out range is $500,000 to $600,000. So, this would apply to, a fair number of taxpayers out there for the next 4 years that this new benefit is provided for taxpayers. And that, the other nice thing is that the phase out range also increases from 2025 through 2029 before the benefit goes away. So
this might be more attractive for some individuals to itemize versus taking the standard deduction if they're eligible to take that $40,000 SALT deduction if they live in a high property tax area.
Right. Yeah. So, I think a lot of taxpayers have been conditioned over the last, 5 years or so plus since the Tax Cuts and Jobs Act, where, maybe they were used to itemizing for so many years and now they're just taking standard deduction because it's so much larger. They've been conditioned to do that. And Kate, to your point, now let's take a look at the numbers, right? And maybe it makes sense to itemize if the total amount of deductions would be larger than the standard deduction. So I think folks should now be paying more attention to how does this apply to my personal situation, depending on how my numbers work out, right? How much am I paying estate taxes? What kind of property taxes am I paying for the house I live in, for example? And then if I add up everything else that I might be doing, like mortgage interest and, any medical expenses that are above.
And a lot of moving parts here too, because kind of with that bonus senior deduction as well, you want to really, especially if you're close to that MAGI phase out range, maybe work with your accountant, maybe do some tax planning, maybe delay income. So you might be eligible for, the full SALT deduction, if that makes sense. And again, trying to keep an eye on the longer term as well, not just making short-term decisions. But, if you're close to that phase out, seeing maybe, can we do things in an efficient manner to make sure that we're maximizing the ability to take this deduction.
Great point. And, the phase out, you talked about how it works for the new senior deduction. Similar concept here where, the deduction is reduced by 30%. By the amount that your adjusted gross income is above the phase out limits here, right? So in the article that was authored by our colleague Chris Cochran, fellow wealth advisor and financial planner, he walks us through an example where, let's say your adjusted gross income was, $550,000. That's $50,000 over the bottom end of that phase out range, and 30% of that would be let's see here, $15,000, right? So now your $40,000 deduction is reduced by 15. So now you're at $25,000, right? Which is still higher than what it used to be, which was 10,000, right? But now you just need to factor that into how the math works for that particular taxpayer's situation, right? And if the total amount of itemized deductions would still be higher than a standard deduction. But the other thing to think about, and this is highlighted in Chris's article in the newsletter with a nice graphic, is thinking about like how this works, right? So you might say to yourself, okay, I still get the $25,000 deduction as opposed to the $40,000, right? Which is nice. But in that example, that earner, is $50,000 above this phase out limit, right? So that's exposed to tax. And now there's $15,000 less of a shield, if you will, of this SALT deduction. So that's, if you add all that up, that's $65,000 that's exposed to income tax. And that'll flow through to the bottom line for that particular taxpayer situation. So, it's important just to think about how this works on both sides of the equation, right? Not only am I getting a lesser deduction, even though it's more than the 10,000 used to be, now I have more income that's subject to tax, even if my benefit might be a little bit higher. So that's a long-winded way of saying that, I think every taxpayer just needs to kind of factor this into where they sit as per the new rules. And the article does a good job with a nice visual, of how that works.
So beware the tax torpedo. And you could be potentially opening yourself up to that higher exposure to having more income being subject to taxation.
Exactly.
So,
the The salt torpedo. It sounds like a cocktail you'd get at a beach bar. You know?
Now you're talking.
You know?
Extra lime is needed.
Yeah.
Yeah.
Mess with a few of those and you're not just losing judgment, you're losing deductions.
Yeah. You know? Oh, it's a double whammy. We're going to have to make this like a holiday version of this cocktail.
Yeah.
Yeah, just throw cranberries in it. Mm-hmm.
There you go. Cranberries and put it in a Christmas mug. You're good to go.
Yeah.
By the way, this is just water. I swear.
Yeah.
A salt torpedo.
All right. So this starts, this year, 2025. So, from a planning standpoint, this would impact different decisions that, that taxpayers are thinking about, Kate, that you talked about before in terms of where income, components are coming in and, what decisions would be most beneficial for the situation. So, this last slide here, I think this might be our last slide, is just, again, talking about, how this works for married filing jointly. And then there is a separate provision for married filing separately where the added deduction isn't $40,000, but it's $20,000. And their phase out range is $250,000 to $300,000. So something to keep in mind on that. And again, just one final reminder that after 2029, this temporary benefit goes away, and then we circle back to the $10,000 cap. It remains to be seen. I'd be kind of curious if there's any kind of inflation adjustment to that 10,000 come 2030. It is, that is several years away. And I think, that matters. So I'll be curious to see how that might play out.
So a lot of moving pieces here, a lot of things, a lot of different changes coming and going. So it can be a little complicated in here. So, really reviewing, I think, with, your tax advisors, your advisors, and to see how these different changes really might impact you, because there's a lot going on, with all these changes.
Yeah. Yeah. And, I think the important part is you have to mix the current satisfaction of avoiding taxes, right, with whatever potential satisfaction you can get from other options, right, when you're running a long-term plan and thinking, 20, 30 years out. So, not to take all these at heart, but to take them as these are things that we need to think about. These are things that I need to incorporate in my plan, right? And how does that impact that net number at the end of the day, at the end of my plan?
Excellent point, Austin. Keeping your eye on that long-term ball for sure.
Yeah. So Kate, Tom, thank you both for breaking all this down with us today. If you want to read the full financial planning newsletter, you can find it anytime on our website. We covered a lot of ground today, and the newsletter goes even deeper on all these topics and more. And to our listeners, thanks for spending your time with us. If you found this helpful, please remember to like and follow and share the show. It helps more people find us, and we really appreciate the support. Thank you.
Thank you all.